Hi, this is Toby with the mortgage firm, and I, as frequently as I can, really try to bring some value to you. In the mortgage business, of course, we run into all types of scenarios that people might have. And today we're going to be speaking with Tony Smith, who is a partner in Ashley Brown and Smith, which is a very long time company here in Charlotte County. And I'll add very well respected to that for Tony. And I've got some questions, Tony, that I want to ask you. It's tax time, and this has been such a different year gone past. And I've got some questions I want to ask you that might or might not affect people from a COVID standpoint and in terms of what they can do, what we can do to totally minimize our tax burden. Is that a bad thing to say if anybody from the IRS is listening to me?
That's not. Not at all.
Okay. So speaking of COVID, well, why don't you introduce yourself first?
Okay, my name is Tony Smith. I'm a partner with Ashley Brown Smith CPAs. We're located in Punta Gorda, right near the courthouse in Punta Gorda. I've been practicing since 2010. I was actually a sophomore in college. I started working with this firm then. Apparently they like me enough to where they've asked me to stick around. So
yay, I can imagine a few reasons why.
Yes, ma'am.
So let me start off by asking a COVID related question. If somebody has been receiving any of the stimulus checks or any other, you would know better than me what other types of money they may have been receiving related to COVID. Do they have to pay tax on this money? What's the deal with all that?
Okay, so the stimulus that they've actually did 2 rounds last year, right? So the stimulus money is not taxable to the taxpayer.
Okay.
However, they will want to, because what happens is well, first of all, it's not taxable. The second part of it is if they haven't received the money yet or are unsure if they qualify for it or not, they can actually give the information to their tax preparer this year for 20, and it'll come out as a credit on their tax returns for 2020.
Oh.
So they'll want to look at their bank accounts. We've had clients that weren't sure if they did receive the first one or the second one or what amounts. So regardless of who your tax preparer is, you want to look back and see how much you received in the first one, how much did your spouse receive in the first one, and how much did you receive in the second one. And your tax preparer will actually put that in their tax preparer software, and it'll help you decide how much.
That's great. And then it just becomes a credit if for some reason they never received one of the payments.
Exactly.
Okay.
And go ahead.
I was going to say, and these payments are all based on what the consumer filed for their 2019 tax returns, correct?
Correct.
Okay.
So one thing to point out is if, say, in 2019 they did not qualify for it, so the government wouldn't have given them any money. But in perhaps 2020, everybody's income has changed for the not so better, right? So just because their 2019 income didn't qualify them for it, their 2020 income very well could have. And to that difference, in 2019, maybe perhaps they didn't make as much as they did in 20. They wouldn't be, if they wouldn't have otherwise qualified for the money, but they say they did, there won't be a clawback, so they won't have to actually pay the money back, which is.
Oh, that's great info. Okay, another question is from a mortgage standpoint, as we work on qualifying and getting people to closing, since COVID, I am having to ask for things from self-employed people now that I literally haven't had to ask for in 30 years. For instance, profit and loss statements. We haven't needed P&Ls for a mortgage on self-employed people, and I think it's been 30 years since I've had to ask somebody for those. In addition to that, on self-employed people, we're also getting 3 months of the business bank statements to kind of verify that money's still coming in as a business. Well, that leads me to quite a few conversations with small business owners that maybe are not in the practice of regularly preparing profit and loss. Right now, if somebody has not and isn't even remotely ready yet for the 2020 returns, we will get a 2020 profit and loss in addition to the tax returns, the previous tax returns, but we'll get a 2020 profit and loss statement and anything else depending on how far into the year that we're in. And I am running into quite a few people that are not regularly preparing P&Ls for their business because it's a small business. What kind of tips can you give about an easy way? Is this where you highly recommend QuickBooks, or what would you tell that business owner that is going to go for a loan and needs to have these profit and loss statements?
Okay, so we're going to go with the presumption that they've already formed their business, whether it's an LLC or a sole proprietor. With the first thing that I always recommend is apply. Make sure you've applied through Sunbiz. You've registered with Sunbiz, sunbiz.org, and then apply to the IRS for an EIN number. What an EIN number is an employer ID number, identification number. And what this is, it's essentially a Social Security, what a Social Security number is for a person. It's the Social Security number, if you will, for the business. So what this does is it enables the business owner then to take that EIN number and the registration from sunbiz.org and go to any banking establishment and open a bank account in that business name. So a lot of times what we see with sole proprietors is they started the business and they're out there making the money, which is good, spending the money, which is good, but they don't have the separation between their personal income and expenses versus the business. And it's very important. So if they open this business bank account and only deposit your income for the business and only write expenses out, you can get a debit card for the business, but only do charge business expenses to this business bank account, then you'll have the separation to where if you're not necessarily ready for QuickBooks, you can kind of go back on a monthly basis or a quarterly basis or even annually if you have to, and you'll be able to see what your actual expenses were. To that extent, I would always recommend first and foremost to consult with your tax preparer or your CPA. It's easier to get started on the right direction than it is to come back later and have to fix a bunch of stuff. It's always cheaper, right?
Oh yeah, not to mention headache minimizer there.
Oh, definitely. And then the other thing is QuickBooks. I really enjoy QuickBooks. I actually prefer, which I know a lot of people don't or might not, I prefer QuickBooks Online. It gives the business person the ease of accessing their business, their finances, and they can also add their CPA or their bookkeeper, their accountant, access to QuickBooks that you wouldn't necessarily have in any other, even in a desktop version. And if they don't want to go with QuickBooks, there is a learning curve. So if you're a new business owner, you're not entirely sure if you want to spend the monthly charge for QuickBooks, You could do as simply as Microsoft Excel, create an Excel sheet, create different columns for the months, and try to keep track of your expenses that way.
Sure. How much does QuickBooks cost? You have any idea on a small business level?
It really depends on if you're going to have payroll, if you want to be able to send invoices. I mean, I think it starts out at like $20 a month and goes up to like $50 or $60.
Okay. A few years ago, I think it might be 3 years ago, the IRS made a change to W-2 employees, that W-2 employees are no longer allowed to deduct business-related expenses.
Right.
Is there any way, or I shouldn't say is there any way, what type of things is a W-2 employee that's, let's say, in a sales related type of business, and they do spend money to get the business? Is there anything they can do now to take deductions?
There really isn't. The government kind of, like you said, kind of created a couple issues a year or so ago, 2 years ago, to where they brought in this larger standard deduction. So now most people who might have itemized their deductions previously or had some type of business expenses and only had W-2 income, they made it really hard to deduct expenses. And I think we'll see that as a change, not now, but in the future. As far as we have a lot of people that aren't going to the office, right? You have these big corporations that have shut down the office and have forcing everybody to work from home. And from home, what do you have? You have, usually if you're going to telecommute, you need internet, you need a laptop. These other expenses that they're going to have to come up with a way to either it comes as a additional income from the employer or as an expense through the IRS to allow these types of expenses. Unfortunately, there just isn't anything right now.
Okay, and just as a regular consumer, what type of things, I read somewhere that I didn't know, and I don't even know if this is true or not, just even things like a safety deposit box, or are there little things like that, or is all of that falling into the larger standard deduction now?
Well, see, the thing is they've increased the standard deduction. Okay, so right now for 2020, an individual gets a standard deduction of $12,400. A married couple, it's just double that.
Okay.
So in the past, where a lot of people gave heavily to charitable organizations, they didn't have enough to itemize. They had more of enough to itemize in previously, but now they just don't have enough. It takes, in order to itemize your deductions, and what I say from that is you take your certain expenses are deductible. So your mortgage interest, your property tax payments on your principal mortgage, secondary home, medical expenses, certain charitable contributions, whether you donated a household items or if you donated cash. This would all go into this pot, sales tax payments that you might have made. This goes into a pot, and then if you have essentially if you're a married couple, if you had greater than $24,800 of expenses, anything above that, it would be beneficial for you. However, your common person, even myself, I don't have enough to itemize. So if you take all those items that I mentioned and you add them up, maybe it would be, for me and my wife, it would be about $15,000. So I'm better off taking the standard deduction of the
24,000, right?
Yes,
right. I tell you another thing I run into is when I'm taking a mortgage loan application, somebody that might own other real estate,
Yes, ma'am.
whether it's investment property in general, and they're doing their own returns. And I don't know, from that standpoint, I always think yikes, because it seems like they'd be so much better off with a professional tax preparer. I mean, I assume that there's several categories that people would miss along the way. I mean, I'll give you an example. I did one the other day, and they're not taking any depreciation.
Okay, and that's usually a big, and it's a very sensitive subject and complex area, to where if you are going to I believe you're talking about more of like rental property, right? So if you're going
somebody preparing their own returns.
Correct. So depending if I've never used TurboTax, so I don't entirely know what which they should be pretty good. But there are expenses that maybe you might not think about, or TurboTax might not even recognize or suggest to you. You're running a business at that point. So anytime you have a chance to, what I always call a side hustle, I think everyone should have one, because that's really the way you can get these regular expenses that if you were a W-2 employee, you couldn't write them off. But as a sole proprietor or a business owner, you can. For example, your cell phone bill. So if you have, say if you're a landlord, you have a couple rental properties, you obviously need your cell phone, right? You're contacting your tenants,
sure.
or you're using it for research on whatever it is. You can write off a portion of your cell phone bills. If you have a small office, home office, you can write off home office expenses.
And that's only though if you do have this side business going on. And you mentioned home office. So many people are working from home now that used to go into the office. That's not tax deductible, is it? If they have an office to go into?
It's not if you have a W-2. If you have a W-2, there's no way to deduct it.
Right. But that's a great idea about another reason why somebody should use a professional to prepare their taxes when they have anything else going on at all, because I would never have even thought of that as a landlord, having cell phone deductions, from a business standpoint, home office, just so landlord just is one. If somebody has created a small business, well, I shouldn't just really say small business, but let's say they're selling a product, and the only name that just comes to mind is Mary Kay, for instance, Mary Kay Cosmetics.
Okay.
Is there any kind of rule about how long they can go from years to having expensed off a lot of things in terms of not showing a profit at a certain point? They can't go on forever showing a loss, right?
Correct. So there's our rules within the IRS that define kind of, is it a hobby? Are you, a lot of times we'll see Sally Sue creates jewelry and she's trying to sell it on the side to make money. Is it a hobby, or is it does it serve a business? You know what I mean? So usually it's 3 years business losses. Usually it's borderline a hobby at that point. Now I'm not saying that if you start a bigger business, a lot of business like new IPOs that you see on the stock exchange, they'll go 5 or 10 years without showing a profit. That's not what I'm talking about. But it's
okay, that's on a whole different level, though.
Yes, ma'am.
Okay. Have I missed any good questions that might that maybe should have asked you?
Yeah, if we can touch on the W-2 employee. So, as take take myself, okay? I do earn a W-2. So if I only had a W-2, there are other ways strategies what you can do to reduce your taxable income. One of them are IRAs. So most businesses these days offer their staff some type of IRA, and a lot of them will do a match. So if you can afford it, and if it's too like a traditional IRA, so if there's multiple forms of IRAs, we could probably spend an hour talking about all the different ones, but a Roth IRA contributions to that are not tax deductible. Okay. However, contributions to a traditional IRA are considered what we call pre-tax. So it actually reduces your taxable income. There are thresholds, there are limitations for it, so not everyone is the same. But businesses, for the most part, if you're the most popular one is a 401k. So most 401ks, you can contribute up to $18,500 to it. So that would reduce your taxable income. That's a lot of money, okay? But the more you can reduce your taxable income, obviously the less taxes you pay. So if your office does smaller businesses, it's called a simple IRA. Okay, so that allows up to $13,500 contribution. Or if if you're just a realtor, there's nothing wrong with that. If you're a realtor and you get 1099s, you could reduce your expenses that way by contributing to a traditional IRA. Or if you're a W-2 employee and your employer doesn't offer any type of IRAs, depending on what your income is, you could contribute to a traditional IRA of up to $6,000. Which would reduce your taxable income.
Yeah. And if you're over a certain age, aren't you able to contribute up to 20?
20 what?
If you're over 62 maybe or something, are you allowed to contribute up to 20,000?
For a 401k or?
Mm-hmm. For some reason I have that.
I'm not sure. I'm not sure on that. Traditional IRAs and Roth IRAs, it does increase it a little bit.
Okay.
For those contributions.
Okay.
Another thing would be a lot of people these days have high deductible health insurance plans.
Oh yeah.
So with that, you would have to check with your insurance provider, but you can qualify for what they call an HSA or a health savings account. This operates as an IRA. Contributions to it are pre-tax, so it reduces your taxable income. And then when you make withdrawals from it, as long as the withdrawals are for medical expenses, you won't pay taxes on the distributions.
Okay. This looks like you're looking at one other thing.
Oh, no, I was just trying to go through my notes. I did note that for 2020, whether you take the standard deduction or you itemize, you are allowed up to $300 tax deduction for charitable contributions.
Okay.
So in the past, you had to, in order to get those contributions as a deduction, you had to have enough expenses to itemize. So for this year, even if you take the standard deduction of $12,400 for an individual, say, they could also contribute up to $300 in cash. It's not a personal item, so you can't deduct. You donated $500 worth of T-shirts. You couldn't deduct that.
Okay. Especially if they had holes in them and were a little faded out.
Yeah, that's correct.
Let me ask you, this has been so informative. I definitely learned a couple of things. Thank you. I really want to thank you for taking the time to do this and to educate everybody, including moi.
Yes, ma'am. Anytime. We're here 24/7. You can, well, I am.
Not
You can
really,
reach me.
20.
No, really? You sure? You can email me. Sure. My response time is very fast.
Thank you.
Yes, ma'am.
I'm Toby Lynn. I'm with the mortgage firm. And I'm here to also help you with any of your mortgage financing needs for purchases and refinances. Hope everybody's having a super great day. And thank you again, Tony.
Thank you, Toby.